Is what's going on in the oil and gas market one of the most immediate and most profound effects we're seeing so far of what's going on?
Certainly the most, one of the most visible, if not the most visible effect, obviously the run up in oil prices. And you showed shots of gasoline prices going through the roof at the beginning of this, as Larry was speaking. And there is no question it's a major issue. Russia produces roughly 10% of the world's oil, exports roughly 5% of it. Oil was already in tight supply before the invasion, not a well-known fact necessarily. A lot of questions about how much excess production capacity OPEC really has. And so if Russian oil production is lost to the world, and I'm certainly not advocating being soft on the Russians, but if Russian oil is lost to the world, it could have a major, major impact on prices. But other commodities, wheat, corn, precious metals, all kinds of commodities have been soaring, again, both before the invasion, but even more so since it, because Russia and Ukraine are sources of a number of important minerals and metals and other components that we need to make things. And that gets into the famous supply chain problems we've been having.
And Afsaneh, from your point of view, is there enough oil to be brought in from the sidelines? Steve referred to perhaps excess capacity in OPEC. We also have things like Iran and Venezuela and maybe more production in the United States.
I think, as Steve has been saying all along, we can, in the longer term, increase the supply of energy, whether it's through LNG, new terminals being built, or through potentially an agreement with Iran and Venezuela to use some of the existing oil, particularly Iran has been stockpiling, I think. But those are all, particularly on the LNG story, it's a much longer term thing. And on Iran and Venezuela, politically, those may or may not happen. So we have the short-term problem, and then we have the long-term problem, David. On the long-term problem, I think the question is, if we wanted to look at just one little positive fact, whether Ukraine will be a turning point, and what climate conversations and COP26 could not do. Ukraine will lead, and energy security will lead US, Europe, and the rest of the developed world to start looking at energy self-sufficiency in a very different way.
And Steve, we're all focused on what this will do to Russia and its economy. There may well be some spring back into the United States and other Western economies as well. Supply chains are pretty intricate. You mentioned supply chains a moment ago. There's a lot of things that we may be getting from places like Russia we didn't know, or even Ukraine.
Sure. First of all, wars are generally not good for economies in the aftermath of wars. You typically get a lot of inflation. You typically get slower growth. You've got to repair war damage. It's obviously not a global war, but nonetheless, that's certainly the history of wars. But in terms of supplies, as I suggested a minute ago, Russia and Ukraine are the sources of a very important number of commodities. Neon gas, which we all think about as going into signs outside bars, is a critical ingredient for making semiconductors. And Russia and Ukraine supply a huge percentage of the world's neon gas. And you can go on from there through palladium and nickel and all kinds of other things that are necessary. And sure, over time, you can probably find other sources for most, if not all of these things. But as Afsaneh was saying in the context of energy, with which I completely agree with her, all this takes a lot of time and it comes at a cost. We are, as you sit here in a normal world, we're obviously sourcing the least expensive, easiest to find places to get all these kinds of things. If you lose a source of supply, you've got to find another place to get it from. And that all adds costs, it adds to inflation, and it retards economic growth in a potentially significant way.
Steve, pick up on that inflation point. We got the CPI numbers this week, as you know so well, 7.9% year over year. And as Larry pointed out already in this program, that's before you really get the full effects of this war. As an investor, what do you do in this world where you already had an inflation problem and it is all likely to become even worse? At the same time, the growth may be deterred. What do? Do you just get really conservative?
Yeah, look, the inflation problem is very worrisome to me, as it obviously has been to Larry for a long time. Inflation in and of itself isn't necessarily the worst thing for investments because the value of companies can go up as well. But the problem really is it puts a lot more pressure on the Fed. The Fed is already going to raise interest rates this week. There was some talk before Ukraine that it might do as much as 50 basis points to try to address the inflation problem. Jay Powell signaled in his testimony more likely to be 25 because of the concerns about growth. And that's fine to kind of keep the world or the U.S. growing, but it doesn't address the inflation problem. And sooner or later, the chickens are going to come home to roost. I happen to have been, in addition to covering energy, I was a New York Times economics reporter in the 70s. I was at Paul Volcker's press conference in 1979 when he announced his whole new framework. I'm not suggesting we're going to go back to that, but this is the first time since then, certainly since the early 80s, that we have had to address both an inflation problem and potentially a growth problem at the same time. That's what we call stagflation. That often leads to recessions. I'm not predicting one, but I wouldn't be shocked if we had one somewhere down the line as a result of all this.
Afsaneh, we spent some time listening to the chair of the Federal Reserve, Jay Powell, saying, we don't think inflation will last. Now he's admitted that wasn't quite right. It's lasted a lot longer. But he kept saying, if it does come, we have the ammunition, we have the tools. Do we have the tools?
We do have the tools, but I think we started a little too slow on starting to increase rates, but also to stop buying securities, which, as we just heard earlier in the program, they're going to start doing also. We're stopping it now, but kind of belatedly. I think everyone has been puzzled why the Fed did not start with that a little sooner. The issue is exactly as Steve was saying, is because now the war and the supply chain problems that were supposed to go away. Remember also, a lot of people in the government were saying that inflation would be halved by the end of this year, right? So whatever, if we're at 7.5, it would be close to 3 to 4%. Obviously, that scenario is not very likely today. And to increase rates enough to deal with that level of inflation, if God forbid we got to two-digit inflation, would be very difficult for the Fed.
Steve, I want to come back to something you just said, which is you're not necessarily predicting a recession. At the same time, one of the questions I have, looking for a half full part of the glass, there was a fair amount of strength in the U.S. economy and strength of the consumer and the household balance sheets going into this. How confident are you that we have enough strength going into this that we can weather what is going to be a storm without a doubt?
Yeah, you're certainly absolutely right to point that out, David. There's still an enormous amount of what I'll call excess savings or savings above normal levels on household balance sheets, going all the way back to the stimulus checks and the amount of relief that was put into Americans' bank accounts, as well as the fact that they did underspend during the heat of the pandemic. So there is definitely a cushion there, which is why I wouldn't suggest there's a recession that's going to happen imminently. But that doesn't necessarily obviate or eliminate the possibility of a recession. It just postpones the possibility of a recession. At the end of the day, people are at the moment having negative real incomes. Their incomes are going up slower than inflation. So to the extent they want to maintain their lifestyles, they have to dip into those savings. Those savings are being eroded by inflation. And as I said, I think it's simply a postponement of what might, and I underscore might, I'm not predicting it, but it's definitely something that we should have on our radar screens, almost certainly not for this year, but potentially for next year.
Afsaneh, last one to you. On your radar screen, the possibility of a recession, and how likely is it?
I think given the huge force of the growth that we've got behind us, I don't see recession. I am hoping that that as we start getting some of the supply chains a little bit under control, the part that was caused by COVID versus the war, I think that will have a positive impact. The big thing that is concerning me, David, is the fact that we saw low wages go up, but now with inflation, the impact, as Steve was saying, is much less. And that could slow down consumption and slow down this growth. But I think for the rest of this year, we have a lot of momentum that will, at least in the US, if not in Europe, which is a very different kind of situation where you might get recession, get us through. And that's why this is probably the haven for investors.